Share screen. Right. So we're going to just be doing the first recording, the first reading, I mean, and yeah, you can see my screen and everything. All right, let's go. So it's very good that if we read the learning outcome statements, because this is what you should know, right? And when you read it, you should sort of apply those things when you're reading, when you're trying to understand the reading as well. So for instance, we're going to do the first reading right now, which is Introduction to Financial Statement Analysis, right? And what the candidate should be able to do, he should describe the steps in the financial analysis statement framework. There's 6 main steps. We should know those by heart because they could be asked in the exam. Then describe the roles of financial statement analysis. C is describe the importance of regulatory filings, financial statement notes, and supplementary information, management's commentary, and audit reports. D is describe implications for financial analysis of alternative financial reporting systems and the importance of monitoring developments. And then E is describe information sources that analysts use in financial statement analysis, besides annual and interim financial reports. Right, so those would be all the forms that would be included. Now let's quickly get to the reading. So there's 6 main steps. And first of all, it says here that the financial statement analysis framework sets out a generic set of steps for analysts to apply to a multitude of objectives when analyzing debt issues, equity, securities, corporate actions. Now, the framework consists of 6 steps. Okay, we're going to quickly go over these. Step number 1 is you're stating your objective and context. Okay, you're saying, what are we trying to find out? Basically, you're kind of underlining the questions. What are the questions that our analysis seeks to answer? What are we looking for? So that's step number 1. Step number 1 is what are we looking for? Basically, state the objective and context. Then step number 2 is gathering data. First of all, what are we looking for? Step number 2 is gathering data. And then, because whenever you have a question, you find data to answer your questions. So where do you gather data? You use the company's financial statements, any other relevant data on its industry and the economy, and then ask questions of the company's management, suppliers, customers, visit company sites. Okay, so 1 is objective and context, 2 is gathering data, 3 is processing data, right? This is where we're making adjustments. We're sort of making the data acceptable. We are making adjustments. If there's any prior period errors, we're fixing those. We're calculating ratios. We're performing statistical analysis. This is very objective, okay? You're just objectively figuring things out. You're not going to give any conclusions yet. You're not going to give any recommendations yet. You're just objectively finding out, okay, what's the net profit margin? What is the gross profit margin? What is the asset turnover? Things like that, but you're not really putting in any analysis yet. You're not saying, oh, the ratios are high, these ratios are high, which suggests that the company is not profitable. No, that comes later. So first of all, just processing the data. Okay, prepare exhibits such as graphs and common size balance sheets. Now, common size balance sheets are simply when you take out, like, the balance sheet has total assets, right? So every single account on the balance sheet, you show that as a percentage of total assets. And then step number 4 is you analyze and interpret the data. Now you do the analysis. You see if the data is answering the questions that you had stated in the beginning, right? The beginning, you said these are the questions we want to answer. Then you do the analysis. Then you interpret the data. Then you say, okay, the asset turnover ratios or the activity ratios are high, which suggests that this company is efficient. The profitability ratios are high, or the solvency ratios are high, the liquidity ratios are low, things like that. Okay, and Tell us what it suggests. What do you think? What are your recommendations? What conclusions do you drive from the data? That's analysis and interpreting the data. And then step number 5 is you report the conclusions. You found out your conclusions, you found out and you've made your recommendations. Now you report them. You prepare a report, you communicate it to its intended audience. If you wanted to show it to your boss, then you show it to your boss. If you wanted to show it to maybe prospective investors, then you show the investors. Be sure the report and its dissemination comply with the code standards that relate to investment analysis and recommendations. Okay. And step number 6 is just we keep on monitoring, right? We keep on updating the analysis. We repeat these steps periodically. We change the conclusions when necessary. So updating the analysis. So those are just the 6 steps, very easy. Stating the objective and context. What are we looking for? Then gathering data. Then we have processing data. And after that, we have analyzing and interpreting data. And then lastly, we have reporting the conclusions and recommendations. And then step 6 is updating the analysis. So stating the objective and context, processing the data, gathering the data. I mixed it up again. Stating the objective and context, gathering data, processing the data, analyzing and interpreting the data, reporting the conclusions, and then updating the analysis. Very simple 6 steps. Have been questioned before in the exam, so it is important to know them. Okay, now this has also been questioned in the exam. They ask us the difference between financial reporting and financial analysis. It's very easy and it's pretty easy to mix up, even though it's a very simple concept. We won't even, so simple that people don't even pay attention to it, right? So reporting refers to the way companies show their financial performance, okay? How are we showing our performance to investors, to creditors, and other interested parties by preparing financial statements? And then analysis is to use the information. So the information that you were showing in reporting, you have to use that information in the company's financial statements along with other relevant information to make economic decisions. So examples of such decisions, the economic decisions that you have to make include, should we invest in the company's securities or recommend them to investors, whether to extend trade or bank credit to the company, and then assigning credit ratings to the company's debt. So there's 3 kind of uses that you could do with the data, right? There's 3 kind of decisions that you could make using this data. So you could decide whether or not to invest, or whether or not to suggest other people for them to invest here or not, whether or not to lend, or you could be deciding on, okay, what is the credit rating that we should give to this company's debt? Should we keep it a AA rating, a AAA rating, a BB rating, right? So 3 main decisions, economic decisions. Yeah. Analysts use financial statement data to evaluate a company's past performance and current financial position to form opinions about the company's ability to earn profits. Is it going to be profitable in the future? And generate cash flow in the future. As part of this process, analysts will identify risk factors that affect the company's future profitability and position. So what are some risk factors that could potentially decrease profits in the future or decrease cash flow in the future? Okay, so this reading is dealing with financial statement analysis for external users, not insiders. So management also performs management of the company, as in the CEO or the employees within the company. They also perform their own financial statement analysis where they make everyday decisions. However, management has the advantage of internal financial information that is sort of unavailable for the rest of the world or the rest of the external users. If I'm an external analyst, right? I don't work for the company, I'm not an insider. Then the information that I have access to in order to make my financial decisions is very different from the information that management or people who work within the company have. Okay. Standard setting bodies. Now, there's 2 differences, right? One second, let me just... Okay, now we have standard setting bodies and regulatory authorities. Just know the difference. Standard setting bodies are the ones who sort of set out the rules. This is this what you have to do, this is what you're allowed to do. And then regulatory authorities kind of ensure that those rules are followed. Very simple, right? So standard setting bodies are professional organizations of accountants and auditors that establish financial reporting standards. And then regulatory authorities are government agencies that have legal authority to enforce compliance. Main thing here. I'm going to take pink because I like pink more. Now, the two primary standard setting bodies are FASB, FASB is what I call it. I know that's not what you should call it, and ISB. Okay, now FASB has set out the US GAAP, which is the US generally accepted accounting principles. And then ISB has set forth IFRS, which is the International Financial Reporting Standards. Now, US GAAP is followed in the US only, and then IFRS is for the rest of the world, for European countries. So US GAAP is for US only, and then outside the United States, so for everybody else, ISB establishes the International Financial Reporting Standards. Other national standard setting bodies exist as well. Some of the older ISB standards are referred to as the International Accounting Standards. So, okay, so IFRS is the newest, and then IFRS is what we follow now, and then the older standards that the ISB set forward were referred to as the IAS. Right, so we know that there are two primary standard setting bodies in the world, which is the IASB, International Accounting Standards Board, and then the FASB, which is the Financial Accounting Standards Board. FASB has set forth US GAAP. IASB has set forth IFRS, which is followed everywhere around the world. Now, regulatory authorities are different from standard setting bodies. Standard setting bodies set the standards, regulatory authorities enforce the standards. Regulatory authorities, we have SEC in the US, and then we have in the UK, United Kingdom, we have Financial Conduct Authority, which sort of enforces standards. Okay, now most national authorities belong to the IOSCO, which is the International Organization of Securities Commission. IOSCO is not a regulatory body. Okay, it is comprised of regulatory authorities, but it itself is not a regulatory body. Think of it as kind of the UN, right? The UN will not go and fight wars on behalf of everyone, on behalf of individual countries, but it has individual countries within it that fight wars or that implement policy in their own countries, right? But the UN's, I'm not very historically aware, but mostly the UN's objective is to sort of kind of create cooperation between countries, right? So most national authorities belong to the IOSCO. Together, the members of the IOSCO regulate more than 95% of the world's financial markets. The members, that's the key word here, right? The members. The IOSCO itself is not a regulatory body. 1 second. Okay. I don't know what idiot in my house where I live, decided to have fireworks at 2 a.m. for no reason, but whatever. Right. So IOSCO itself, IOSCO itself is not a regulatory body, but it is comprised of regulatory bodies, and the members of the IOSCO regulate more than 95% of the world's financial markets. IOSCO is not a regulatory body, but its members work together to improve cross-border cooperation and make national regulations and enforcement more uniform around the world. So enforcement should be more uniform around the world, as in there should be less differences in the way that we enforce the standards. IOSCO objectives and principles of security regulations are based on 3 objectives, which is protecting investors, ensuring markets are fair, efficient, and then reducing systemic risk. These 2 are pretty self-explanatory. Systemic risk is different from systematic risk. Systemic risks means that, so for instance, banks are very interdependent, right? If one bank kind of fails, all other banks might fail. And that is the kind of risk that we're trying to avoid. The risk, because financial markets are so intertwined and so interdependent, if one fails or if one collapses, then there's a high probability that others will collapse too, right? So stopping that kind of risk is reducing systemic risk. Okay, and then we have, more about IOSCO. IOSCO requires issuers to provide full, accurate, and timely disclosure of financial results, risk, and other information used in the decision-making process. It also requires accounting standards that are used to prepare financial statements to be of a high standard and internationally accepted. Okay, the SEC's requirements for financial reporting by US companies are shown. SEC has the responsibility of enforcing the Sarbanes-Oxley Act of 2002. Now, Sarbanes-Oxley Act of 2002 was this act that was a kind of regulation that came into being after the Enron case. Now, Enron was a company that was basically using, it had this auditing firm called Arthur Andersen, and they were auditing Enron. But Arthur Andersen was also performing a lot of other services for Enron. For instance, they were providing consulting services to Enron too, right? So now, why would a company, an auditing firm, give you a bad review or give you a bad auditor's opinion, like an adverse opinion or a disclaimer of opinion, when you're giving them so much business, right? You're giving them, they're doing your consulting, they're doing your auditing, they're doing so much more for you, and they're getting so much revenue from you. So there's a high probability that they're going to give you very good reviews as well, right? They're going to say that your firm is great. They're going to give you an unqualified opinion, which is the best opinion that you can give, even though it sounds kind of contradictory because unqualified means worst, right, in English. But that's the best opinion that you can get. So the Sarbanes-Oxley Act basically stated that if an auditing firm is auditing a company, then they should not be doing anything else for that company. They should not be giving any other service to that company. So the Act prohibits a company's external auditor from providing certain additional paid services to the company, right? Because if you're giving them so much business, they're not going to give you a bad review. If you're saying, हाँ हमारी consulting भी आप कर लें, हमारे और काम भी आप कर लें, so they're going to give you good reviews because they'll be like, we're getting so much revenue from this. Why should we give them a bad review? Why should we lose out on all this business? So to avoid the conflict of interest involved and to promote auditor independence, the Act requires a company's executive management to certify कि जो financial statements हैं हमारी, they are fairly presented. ठीक है? They're going to include a statement also, and they're going to talk about the effectiveness of the company's internal controls of financial reporting. So हमारी जो financial statements हैं, they're fairly presented. Our auditors don't offer us any other additional paid service, and therefore they're independent. And we are also going to issue a statement जिसमें हम कहेंगे कि हमारी company की जो internal controls हैं वो बहुत effective हैं. Financial reporting is effective. So include a statement about the effectiveness of the company's internal controls of financial reporting. Additionally, external auditor जो है, he must provide a statement confirming the effectiveness of the company's internal controls. So executive management है, they are going to certify कि financial statements fairly presented हैं, and they are going to give a statement about the effectiveness of the company's internal controls. And the external auditor himself also is going to, not just a person, the external auditor can be a firm as well. So the external auditor is itself going to give a statement that's going to confirm the effectiveness of the company's internal controls. Okay, now what are proxy statements? Now look at the annual general meeting. All companies have an AGM. Us AGM mein, they come together, right? The shareholders of the company come together, and any important matter, for instance, a matter as if, okay, who should be our next CEO, or who should be our next CFO, or what should we pay the CEOs? Should we issue stock options? Any matter that is important or that is relevant, they will take a shareholder vote on that, right? Because shareholders are effectively owners of the firm. So in the AGM, which is the annual general meeting, all the shareholders are going to come together and they're going to be expected to vote. Now, what happens is shareholders typically, a lot of them can't attend that meeting, right? So they're given a proxy statement, which is kind of like that takes their vote. So proxy statements are issued to shareholders when there are matters that require a shareholder vote. Usme the shareholders give their vote and those proxy statements are sent back to the AGM. That's just kind of like telling the shareholders about what's going on. They're filed with the SEC as well. They are a good source of information about the election and qualifications of board members, compensation, management qualifications. So again, this is very important. Election and qualification of board members, compensation, management qualifications, and issuance of stock options. Yeah, because the proxy statement is like a lot of the shareholders, they cannot attend the meeting in person, so they're given a proxy statement. Usme unko bataya jata hai ki okay, this is what happened in the meeting and what do you say, what is your vote on this, right? And mostly these decisions are about the election, who should lead us, who should be managing us, who and what should we pay them, compensation, how qualified should this leadership be, and also stock options, right? Stock options is what we give to employees, and we give employees stock options. We say that you can buy our shares at a fixed price whenever you want. So again, we are effectively making employees owners of the firm, right? So this has to do a lot with leadership and ownership. Who's going to lead the firm? How qualified are they going to be? How are they going to be compensated? What are they going to be given? So these proxy statements, which are given to shareholders, के अच्छा आप meeting पे नहीं आ सकते, ठीक है, just tell us about what you think, vote here. And in statements, there's a lot of information we can find. We can find information about election qualification of board members, compensation, and management qualifications or issuance of stock options. In the European Union, each member state has its own securities regulations, but all countries in the EU are required to report using IFRS. Okay, European Commission also has established the European Securities Commission. So like we read about the Financial Conduct Authority in the UK and the SEC in the US, in Europe you have the European Securities Commission, which advises the European Commission on securities regulation issues and the European Securities and Market Authority, which coordinates regulation within the EU. Securities and Market Authority. Okay. Footnotes. I think this is not that important because I've not seen it in mock exams or anything. So, and I don't even, language is quite weird and confusing. We can just leave this out. But itna yaad rakhna chahiye कि European Commission has also established the European Securities Commission. अच्छा, financial statement footnotes में ना, they provide disclosures about further details about the information summarized in the financial statements. So financial statements are just a bunch of numbers, ठीक है? Footnotes are very objective in nature. जो मैनेजमेंट कमेंट्री होती है वो थोड़ी सब्जेक्टिव होती है, बट फुटनोट्स ना बहुत ऑब्जेक्टिव होते हैं और वो आपको बस एडिशनल इन्फॉर्मेशन दे रहे होते हैं. They are telling you things जो कि you otherwise could not have known. ठीक है, you could have not known them unless and until you read the footnotes, because you just would not have access to that information. आप notes मतलब numbers देखोगे balance sheet पे, there are certain things आपको नहीं पता चलेंगी. There are certain, let's say कोई accounting policy है, कोई estimate बनाया है management ने, कोई economic condition है, things you would not know until and unless, मतलब आपको एक complete picture नहीं मिलेगी until आप footnotes नहीं पढ़ोगे. So footnotes allows users to improve their assessment of the amount, timing, and uncertainty of the estimates reported in financial statements. Footnotes do the following. सबसे पहले they're going to discuss the basis of presentation, such as fiscal period. Okay, January to December is the period जो कि हमने financial statements में cover किया है. और then हमने IFRS use किया है, हमने US GAAP use किया है, and then the inclusion of consolidated entities, as in, okay, हमने it's not just this one company that we're reporting about, there is इनकी सारी subsidiaries के बारे में भी reporting हो रही है within the financial statements. And then accounting methods, assumptions, and estimates used by management. You could not know this if you hadn't looked at the footnotes. If you just looked at the balance sheet and the income statement and the cash flow statement, how would you know about the accounting methods? How would you know about the estimates? How would you know about the uses by the management? They provide additional information on information included in primary financial statements and items such as business acquisitions. Okay, we acquired this within the year, we disposed of this within the year, legal actions that we took, employee benefit plans, pension plans, contingencies and commitments. Contingencies as in the future, if this event happens, then we would have to pay this much. If this event didn't happen, we wouldn't have to pay this much. Commitments, we have committed to buying 10,000 gallons of oil in the future, whatever, right? Significant customers, related party transactions, position and performance of segments. This is also very important. Segments details are going to be in the footnotes of the firm. Significant post-balance sheet events, events that happened after the reporting period, but were not included. They are audited along with the primary financial statements. Very important to know this as well. Okay, then we have sorry, why am I glitching? SEC required filings. ठीक है. So you have a bunch of forms here. Form S1 जो है, it is registration statement filed before the sale of new securities to the public. इसमें डिस्क्लोजर्स हैं कि सिक्योरिटीज क्या ऑफर हो रही हैं, ऑडिटेड फाइनेंशियल स्टेटमेंट्स दी हुई हैं. If the statement is filed more than 3 months after year end, risk assessment, underwriter identification, मतलब all the information that you would probably need to make a decision. So this is the information that's given to you in form S1. It is the registration statement filed before the sale of new securities to the public. बस ये याद रखो. इसका contradictory है Form 144, Form S1, Form 144. Form 144 is a company can issue securities to certain qualified buyers. Isme no registration statement required. Without registering the securities with the SEC, and over here, where did I go? I lost my page. I lost my page again. I'm back on my page. Yeah. So Form S1, it is the registration. You talk a lot, you mix up words. It is a registration statement filed before the sale of new securities to the public. And iska other counterpart is Form DEF 14A. This was to public and the registration was involved. Over here, no registration and to certain qualified buyers only. When a company fires, no, not Form DEF 14A, sorry, Form 144. So Form S1 ka counterpart is Form 144. So a company issues securities to certain qualified buyers without registering the securities with the SEC, and it must notify the SEC that it intends to do so. Form 10K. This is annual filing that includes information about business risk and management, audited financial statements and disclosures, disclosure about legal matters. Information required in Form 10K is submitted to that which a firm typically provides in its annual report to shareholders. However, firm's annual report is not a substitute for the required 10K filing. So again, this is very similar to S1, but S1 is the registration statement that you file before the sale of new securities. Okay, so if you're issuing shares, then you're going to file Form S1 and shares to the public. Form 144 is if you're issuing securities, there's no registration statement here and you're issuing securities to qualified buyers only. Form 10K, this is just, it's the form जिसमें सबसे ज़्यादा information होती है. Audited financial statements, annual filing, just everything you would have in the annual reports. But the annual reports, again, are not a substitute to Form 10K. You have to file Form 10K. Equivalent SEC forms for foreign issuers in US market are Form 40F for Canadian companies and Form 20F for other foreign issuers. So in the US, if there is a Canadian company, they're going to have to file 40F. So if in the US it's a US company, they're going to file Form 10K. If it's a Canadian company, they're going to file 40F. And if it is any other foreign company within the US, then 20F. So just remember 10K, 40F, 20F, KFF. Form 10Q, this is filed quarterly. 10K was filed annually, 10Q was filed quarterly. It has interim financial statements. This had annual financial statements. This is interim as in like if every quarter the financial statements are given. These statements do not have to be audited. Form 10K statements, audited financial statements, 10Q unaudited, interim financial statements. Disclosure about certain events such as significant legal proceedings or changes in accounting policy. Non-US companies are typically required to file the equivalent Form 6K. So 10Q is unaudited financial statements, unaudited interim financial statements, and for non-US companies within the US, they're going to file Form 6K, and this is not audited. DEF 14A, when a company prepares a proxy statement for its shareholders before the annual meeting or other shareholder vote, it also files a statement with the SEC as Form DEF 14A. So अगर आप proxy statement बना रहे हो before the annual meeting, you're going to have to file DEF 14A. 8K, companies must file this form to disclose material events, including significant asset acquisitions and disposals, changes in management or corporate governance, or matters related to its accounting, its financial statements, or the market in which the securities trade. And then Form 144, again, I said as before, this is when you form that you file before the sale of securities, but there's no registration required here, and you file this to qualified buyers only. 3, 4, and 5 involve the beneficial ownership of securities by a company's officers and directors. So ownership, beneficial ownership, as in they own shares of, for instance, if I work in a company as a CEO and I own the shares of that company as well. So owned by insiders. Analysts can use these filings to learn about purchases and sales of company securities by corporate insiders. So very simple, S1, you file this before the sale of new securities to the public, okay? And this is the registration statement. Then Form 10K, this has your annual audited financial statements, your disclosures, legal matters, information required in Form 10K is similar to which a firm typically provides in its annual report. And then for Canadian companies within the US, the equivalent form is 40F. For non-US companies and non-Canadian companies as well, the equivalent form is 20F. Okay, Form 10Q has unaudited interim financial statements. And then the equivalent for non-US firms within the US is Form 6K. DEF 14A, whenever a company is preparing a proxy statement, then they have to file DEF 14A. 8K, this is significant material events. Anything that's important, anything that happened that we should know about, then you file that in Form 8K. Form 144 is a company can issue securities to certain qualified buyers, again, without registration. Form 3, 4, and 5 is beneficial ownership by insiders. So again, just what I also help you guys do is memorize things within my videos. You watch them, you'll just remember things. So Form S1, registration, sale of new securities to the public. 10K, audited annual financial statements. Equivalent is 40F, and for Canadian companies, 20F for foreign companies. Form 10Q, this has unaudited interim financial statements. Equivalent is Form 6K. DEF 14A, whenever a company files a proxy financial statement, or prepares one before the AGM, they have to file Form DEF 14A. Form 8K is significant material events, such as asset acquisitions, disposals, changes in management or corporate governance. Form 144 is securities to certain qualified buyers, no registration requirement here, but you must notify the SEC. And then 3, 4, and 5 involve beneficial ownership of securities by a company's officers and directors. Okay. Now, what it's saying here is both US GAAP and IFRS require companies to report segment data, but required disclosure items are only a subset of the required disclosures for the company as a whole. Nonetheless, an analyst can prepare a more detailed analysis and forecast by examining the performance of business geographic segments separately. Segment profit margins, asset returns can be useful by getting a clear picture of overall operations. For forecasting growth rates of segment revenues and profits can be used to estimate future sales and profits and to determine the changes in company's characteristics over time. So what it's basically saying is that it is very good to have segment data. You can look at segment profit margins. You can look at asset utilization. You can look at ROA of segments, and you can kind of predict how the company is going to do overall in the future. And it's a very good picture, a very good bird's eye view of the firm's overall operations. You can forecast with segments. You can look at segment growth rates, and that could help you estimate future sales and profits and determine changes in company characteristics. So basically, it's just saying that segment data is very beneficial for us because it helps us predict and it helps us understand overall the company's performance and how the operations are performing overall. And it also helps us sort of forecast how the company's sales and revenue is going to look in the future. Sales and profit, sorry. Okay, now it says here कि जो business segment है, it is a portion of a larger company that accounts for more than 10% of the company's revenues. So for instance, if I have a textile segment, but it only accounts for 9% of my revenue, I cannot call that a segment. That's too small to be a segment, right? So if it's more than 10%, then only it can be called a segment. If textiles or let's say shirt manufacturing make up 20% of my revenue, then that is a segment. And it also says that segments reported should account for a minimum of 75% of the firm's external sales. Now, when you're reporting your sales, you can't say that, okay, the water division gives me 30% profit and the ice cream division gives me 20% profit. No, that's like you're showing 50% of your sales in segments. You need to show 75% of your sales in segments. So you need to say, okay, the water division gives me 30% profit, the ice cream division gives me 40% profit, the chocolate division gives me 5% profit. So in total, you're reporting at least 75% of your sales in segments. Okay. So segments reported should account for a minimum of 75% of the external sales. Just a fancy way of saying that 75% of your sales should be reported in segments. Okay, when you're reporting your segments, you should disclose. In my experience, at looking at the mock exams and everything, disclosures are not that important, but just let's look at them. When you're disclosing, following must be disclosed. So you should look at revenue, measure of profit loss, measure of assets and liabilities. Interest, acquisitions, intangibles, depreciation, other non-cash expense, income tax expense, share of equity, accounted investment results. Anyways, not very important. Geographic segments are also identified when they meet the size criteria. So let's say the Mexico segment or the northern segment or the southern segment, right? So that's a geographical segment. You've divided it based on geography, based on location. They should meet a size criteria given previously, and the geographic unit has a business environment that is different from that of other segments or the remainder of the company's business. For example, they've given a really good example. Boeing described its business segment as follows. So we are organized based on products and services we offer. So the segments, again, will be organized in products and services. 5 principal segments, commercial airplanes, that's a product. Our defense, space, and security business comprises three segments: Boeing military aircraft, network and space system, global services and support. Now, commercial airplane, the revenue for commercial airplanes will look very different from military aircraft, right? The revenue will be completely different. So it's very important to report segments separately so that you can look at, okay, what you can look at individual revenue, how much revenue is coming from commercial airplanes, how much revenue is coming from military aircraft. And then you have management commentary. Now, management commentary, it's very easy to get this mixed up with the footnotes, right? What you should know is that management commentary is more subjective. It's management's opinion or what they think, whereas footnotes are more objective. They're giving you information that you would not have otherwise access to or you would not be able to understand. So management commentary, which is also known as management report, operating and financial review, or management discussion and analysis, MDNA. Yeah. IFRS guidance recommends that management commentary address the nature of business, management's objectives, what is management trying to achieve, company's past performance, performance measures used, company's key relationships, resources, risks. Some parts of management commentary may be unaudited. Most of it is audited, some may be unaudited. Footnotes are audited. For publicly held firms, SEC requires management commentary to discuss trends and identify significant events and uncertainties that affect the firm's liquidity, capital resources, and results of operations, so significant risks. Management must also discuss the following. So effect of inflation and changing prices, if material, of balance sheet obligations. So for instance, if you've signed a contract, then that contract is not a liability, but it's an obligation. You have to do it, right? Contractual obligations, such as purchase commitments. Accounting policies that require significant judgment by management. So for instance, let's say the useful life. Who decides that, right? Useful life of an asset, 10 years, 6 years. So accounting policies that require significant judgment by management, forward-looking expenditures and divestitures. Now, now we have a discussion on audit. What is an audit? It is an independent review of an entity's financial statements. Public accountants conduct audits and examine the financial reports and supporting records. Objective of an audit is to enable the auditor to provide an opinion on the fairness and reliability of the financial statements. Now, what do the independent certified public accounting firm, it has to be independent. You cannot hire a firm that's also working for you in some other way, right? It has to be independent, no interest in the company. What does it have to do? It is responsible for seeing financial statements conform to the applicable accounting standards. The auditor examines the company's accounting and internal control systems, confirms assets or liabilities, generally tries to determine that there are no material errors. Auditor's report is an important source of information. That's the auditor's report, and they give it, and it's a very important source of information for analysts. Now, standard auditor's opinion, this is pretty important from an exam perspective. We have to memorize that because there were quite a few questions on this. So one is financial statements are prepared by management and are its responsibility. Main point here is auditor has performed an independent review. Okay, auditor is not biased by anything. GAAP was followed, generally accepted auditing standards. Sorry, not GAAP, generally accepted auditing standards, not generally accepted accounting principles. Generally accepted auditing standards were followed, and reasonable assurance can be provided that the financial statements contain no material errors. So 2 points here. Accepted accounting standards were followed, no material errors. Now you can get an MCQ where, because I've seen that in the mock exams, they're giving an MCQ where they're stating that In the standard opinion, or let's say unqualified opinion, the auditor is saying that there's absolutely nothing wrong with these financial statements, and we can guarantee you that there's nothing wrong. Something like that, obviously in better words. So that is not correct, because the standard auditor's opinion is only going to say that we can provide reasonable assurance. Okay, we're not giving you any guarantees. Auditor is satisfied that the statements were prepared in accordance with accepted accounting principles and principles chosen and estimates are reasonable. Auditor's report must also contain additional explanation when accounting methods have not been used consistently between periods. So number one is auditor has performed an independent review. Number two is generally accepted auditing standards were followed. And we can provide reasonable assurance that the financial statements contain no material errors. Number three is generally accepted accounting standards were followed. Principles chosen, estimates, they were all reasonable. And then the auditor report must also explain when accounting methods have not been used consistently. So if you were using one accounting method in year one and a different one in year two, the auditor should put that in his report that they're changing their accounting methods quite a bit, which could indicate that there might have been some manipulation or something like that. Now you have opinions, unqualified, qualified, disclaimer of opinion. The best one is unqualified. That's the best one. Even though it's quite contradictory, unqualified is like someone who doesn't know their stuff, right? But here, unqualified is the best one. It is also known as unmodified opinion or clean opinion. Auditor believes statements are free from material omissions and errors. Okay, but if the statements have any exceptions, like if everything is fine, but there are some problems, exceptions to the accounting principles, the auditor may show a qualified opinion and explain that these exceptions in the audit report explain these exceptions. Then, third degree is an adverse opinion. The statements are not presented fairly, materially non-conforming with accounting standards. They don't follow accounting standards. They are not presented fairly. Qualified opinion, they do follow accounting standards, but there are some exceptions that they make. Disclaimer of opinion is the worst. It is so bad that the auditor is not even able to express an opinion. So he's going to show a disclaimer of opinion. Any opinion other than unqualified is also called modified. Auditor's opinion will also contain an explanatory paragraph. Explanatory paragraph has to do with certain uncertainties, certain problems that might happen. When there's a loss that is probable, but you cannot determine the amount. The going concern assumption, we are not sure. The auditor may say that we are not sure that this company will even continue to operate in the future. Valuation or realization of asset values. So the auditor can say that the assets, although they are reported at this number, we are not sure that this is what they're worth. Litigation, we are not sure. We think that there is a possibility of a court case happening, which may cost this company a lot in the future. So any type of like major uncertainty, which is pretty disastrous for the company, would be in this explanatory paragraph. This type of disclosure may be a signal of serious problems and may call for close examination. Internal controls, again, processes by which the company ensures that it presents accurate financial statements. Internal controls are the responsibility of management. For publicly traded firms in the United States, the auditor must express an opinion on the firm's internal controls. The auditor can provide this information separately or as a fourth element of the standard opinion. Standard opinion has three things. The auditor can also express an opinion on the internal controls. Auditor must also report a section communicating key audit matters. Now, key audit matters can this highlights accounting choices that are of greatest significance to users. This would include accounting choices that require significant management judgments. Again, like let's say depreciation, right? Depreciation expense is a major expense. And that depends on the useful life that management charges. Now, management could charge a very high useful life or a very low useful life. A very high useful life would lower depreciation expense and make your income look much higher in all the years. So again, significant management judgment is required in these accounting choices. How significant transactions during a period were accounted for. Choices that the auditor finds especially challenging or subjective. Now, subjective choices जो होती हैं, जो management judgment होती है, like it's very hard to know if this is right or wrong, right? It's based on judgment. It's not based on fact. So again, it's very hard, very challenging, and very subjective. So again, that's what key audit matters is. Accounting choices that are of greatest significance, accounting choices that require significant management judgment, significant transactions, हर चीज में significance आ रहा है, significance to users, significant management judgment, significant transactions during the period were accounted for, and any choices that the auditor finds especially challenging or subjective. Okay. Now, this is just telling us some major differences between US GAAP and IFRS. There's a lot more differences, but they come in later readings. Now, US GAAP is developed by, again, FASB, IFRS is by ISB, already discussed before. US GAAP is more rules-based, whereas IFRS is more principles-based. US GAAP says, okay, these are certain rules, you have to follow them. IFRS is more like principle. If you're right in principle, if you're doing the thing right, we're not very strict about how many rules, right? It's like rules based is like if your mom says to you, be home by 9. IFRS principle based is like if your mom says to you, don't stay out too late, right? So again, rules and principles. US GAAP is stricter, IFRS is more principle based. Inventory valuation. Now we just need to know this, that IFRS says you cannot use LIFO. You cannot use last in, first out. You have to use first in, first out or weighted average. US GAAP allows LIFO, FIFO, and weighted average. IFRS, on the other hand, prohibits LIFO. Product development costs. Development costs are expensed under US GAAP. In IFRS, under certain conditions, they may be capitalized. Interest paid is a part of cash flow from operations under US GAAP. In IFRS, it could be a cash flow from operations or a cash flow from financing. Reversal of inventory write-downs under US GAAP, it is prohibited. Under IFRS, allowed. You can, for inventory write-down is like, you basically have to record inventory at, we will discuss this in the inventory chapter as well, but you have to record inventory at the lower or of its cost or its net realizable value, which is just the fair value minus cost to sell. So if cost was 10,000, but NRV is, let's say, 5,000. So you have to report it in the balance sheet as 5,000. That means you're making a loss of 5,000, 10,000 minus 5,000 equal to 5,000, loss of 5,000. That loss will go in your income statement. But think this. Now the NRV again rises to, let's say, 11,000. So you had previously reported a loss. Now you have to reverse that loss. In US GAAP, you can do that. In US GAAP, you cannot do that. But in IFRS, it is allowed. Again, because there's so many differences, you have to exercise caution when making comparisons between firms operating in different jurisdictions. If I'm comparing a firm in the US with a firm in, let's say, Europe, I need to be aware of these differences because these differences are going to impact the financial statements. Analysts should be aware of new products and innovations in the financial markets that generate new types of transactions. Analysts can use the financial reporting framework as a guide for evaluating what effect new products or transactions might have on financial statements. To keep up to date, analysts can monitor professional journals such as the ISP and FASB websites. You can also look at the CFA Institute website, the CFA Institute position papers on financial reporting issues through the CFA Institute Center for Financial Market Integrity. Not testable, but I don't know, maybe they get schizophrenia and they decide, we want this to happen. We want to test this weird information that we've never tested before, and they decide to ask us this, so we should remember it. Now, one of the main learning objectives was that what is the other information that analysts use in financial statement analysis besides annual and interim financial reports, right? So you have your reports, obviously, but you have other information sources as well. You have earning calls. These are targeted at, wait 1 second. Earning calls are kind of like, so you basically issue your financial statements, then you have this kind of press conference. And a bunch of people come here, they discuss the financial statements, what was in them, the reports, the results, everything's just discussed here. Targeted at investors, analysts, members of the media. Earning calls include presentations by the company's management and the opportunity for question and answer sessions. And then earnings guidance is more like, okay, so you have the financial statements come out, they're published, then you have earning calls, then you have earning guidance. Earning calls discuss what happened in the financial statements, the results of the financial statements earning calls have to do with the present. Earnings guidance has to do with the future. It's kind of like a hint. In the future, we expect revenues to go up. In the future, we expect profits to go up. In the future, we expect expenses to go down. Things like that. What do we expect for the future? Earnings guidance. So before they release their financial statements, after an earnings announcement, senior management may hold a conference call to answer questions and Firms often provide earnings guidance before they release their financial statements, which is like more of a hint. And then after announcement, senior management may hold a conference call to answer questions and provide information. Ad hoc presentations. They're similar in format to an earnings call, again, like a conference. You call a bunch of people, you tell them about your company. Press releases, communications with management, investor relations, company personnel, and should note that these additional sources of information provided by issuers are unlikely to have been audited. This is main point from exam perspective. Public third-party sources, things that are available to basically everyone, right? Free industry reports, white papers, trade journals, government agency-produced economic and industry statistics, generalized and industry-specific media sources, social media, proprietary third-party sources, analyst reports, reports from data platforms such as Bloomberg, Wind, FactSet, and then primary research, studies commissioned by the analysts. Analysts has paid someone else to make studies. Hands-on experience with the company's product or services, data and advice of technical specialists employed by the analyst. So the analyst could sort of outsource his own job, ask other people to do it. Studies that the analyst commissions, data and advice of technical specialists employed by the analyst. These are again sources of information. And you should also be aware of economic conditions, the company's industry, what are the benchmarks, compare the company to the competitors. This can be acquired from trade journals, statistical reporting services, and government agencies. Now questions. Which of the following statements least accurately describes the role of financial statement analysis? Least accurately. B. This is what an audited report does. Accounting estimates, assumptions, and methods chosen for reporting is found in the financial statement notes. Again, more objective. If an auditor finds that a company's financial statements have made a specific exception to applicable accounting standards, she is most likely to issue an exception, so a qualified opinion. We can just review, information about the elections of the members to a company's board of directors is most likely found in a 10Q filing. This was unaudited interim financial statements. So proxy financial statement would be the answer. Which of these steps is again least likely? And they're asking us financial statement analysis framework. So state the purpose in a context of the analysis. This is there. Determine whether the company's securities are suitable for the client. Adjust the financial statement data. This is again processing the data. This is stating the objective. This is irrelevant. This is B. Segment disclosure. B, I'm not sure about this one. Proprietary third-party source. You can see here that proprietary third-party sources were analyst reports, reports from data platforms such as Bloomberg, Wind, and FactSet, reports from industry-specific agency. These are like public third-party sources. This is proprietary third-party source. We can look at the answers now. This is correct. This is correct. This is also correct. Firms are not required to provide detailed financial statements for segments that would include line items such as cost of goods sold, but the following should be disclosed: revenue, measure of profit loss, that means earning, revenue, earnings, liabilities and assets, interest, acquisitions, depreciation, other non-cash expense, income tax. So research reports provided by analysts are rarely in the public domain. So proprietary third-party sources are things that are not available to the public. 7A. So we were right. I was right for all of them. Yay. Okay. Now let's go on to Schweitzer real quick. The Q bank. So it says here, which of the following statements about financial statement analysis and reporting is least accurate? And the correct answer is financial statement analysis focuses on the way companies show their financial performance to investors. This showing your performance, this is reporting. So they were asking us about analysis. That's why that's the correct answer. And then according to IFRS, guidance for management commentary addressing the company's key relationships is again recommended. Very simple. We just read this. It's a fact. IFRS recommends that management commentary address the company's key relationships, but it's not required. It's recommended, but not required. As well as the nature of the business, management's objectives, the company's past performance, and the performance measures used. This exact paragraph, we just read it. Then question 3. Which of the following statements regarding footnotes to financial statements is least accurate? Least accurate, okay? Not most accurate, least accurate. They may contain information regarding contingent losses. This is accurate, they do. Because we read that they provide information about contingencies and commitments, provide information about estimates and assumptions and estimates, and then typically include a discussion of the firm's past performance and future outlook. This is part of management commentary. So this is least accurate. That's why I said just it's very important to know the difference between management commentary में क्या है, footnotes में क्या है. 4 is for publicly traded firms in the United States, the management discussion and analysis, which is the management commentary, portion of the financial statements disclosure is least likely required to discuss capital resources and liquidity, results of operations, unusual or infrequent items. This is part C. For publicly traded US firms, is required to discuss results of operations, capital resources and liquidity, and a general business overview based on known trends. A discussion of unusual, infrequent items may be included in the management discussion and analysis, but is not required. Okay. Question 5 of 22. Which of the following best describes financial reporting and financial statement analysis? So the first option it says financial reporting refers to how companies show their financial performance, and financial analysis refers to using the information to make economic decisions. So the first option it's correct. We don't need to read the rest, right? So correct. A. Which of the following is an independent auditor least likely to do with respect to a company's financial statements? Least likely to do. Again, pay attention to these words because that's how you're likely to mess up. Confirm assets and liabilities contained in them, prepared and accept responsibility for them. B, right? Because the auditor, that was part of the standard auditor's opinion. The responsibility is of the management. The auditor can only provide reasonable assurance कि ऐसा हुआ, ऐसा नहीं हुआ. We can reasonably assure you, but we cannot provide you a guarantee. We cannot take responsibility. We cannot claim this. According to the ISP, which of the following least accurately describes financial reporting? Financial reporting is useful to avoid least accurately. Uses the information of the company's financial statements. This is B. That is describing financial statement analysis, not reporting. Reporting is how you show information. Analysis is how you use information. The role of financial statement analysis is most accurately described as C. Use of information from a company's financial statement along with other information. Then question 9 of 22, which of the following is the best description of financial statement analysis framework? State objective, gather data, process data, analyze, interpret data, report conclusions, and update the analysis. Very easy, the steps we know. Just need to remember them. And you don't even need to remember them. It's very logical, right? कि आप पहले अपना objective state करोगे, फिर आप उस objective को solve कैसे करोगे? Data नहीं होगा तो first gather data, फिर उस data को process करोगे, उसकी objective findings ढूंढोगे अपने, फिर उसको analyze करोगे, फिर अपनी conclusions को report करोगे, and then finally analysis को update करोगे. Question 10. Which of the following would not require an explanatory paragraph? Doubt regarding the going concern assumption. This would require an explanatory paragraph. That's why we don't include it. Uncertainty due to litigation. This would obviously, explanatory paragraph is like really serious matters. Statement that the financial information was prepared according to GAAP. No, this is a part of the standard auditor opinion. Should be included in the regular part of the auditor's report and not as an explanatory paragraph. An explanatory paragraph is something additional, it's something extra. 11 is, in addition to the audited financial statements included in the firm's annual report, which of the following sources of information is most likely to contain audited data? The footnotes. So very simple. A firm employs a new type of financial transaction that has a material effect on its earnings. An analyst should most likely be suspicious of the new transaction if management has not explained its business purpose. New types of transactions may emerge that are not covered by existing accounting standards. So these are like innovations. That's fine. Analysts should obtain information from a firm's management about the economic substance of such transactions to ensure that they serve a business purpose. If there's no purpose, then they're very prone to manipulation. And have not been created primarily to manipulate the firm's financial statements. Okay, 13. Steps in financial statement analysis framework that includes making any appropriate adjustments to the financial statement, calculating ratios, best described as processing the data, right? We don't even need to look at this, the answer, we know this. Which of the following statements about proxy statements is least accurate? Not most, least. Proxy statements are a good source of information about qualification. This is accurate. Not filed with the SEC. Wrong, they are filed with the SEC. Available on the Edgar website. This is also accurate. "15. Firm's internal control most likely decides responsibility of the firm. No. Directly affecting the firm's financial reporting quality. Yes. If you don't have internal controls, then your financial reporting quality will be low. Weak internal controls provide an opportunity for low quality or even fraudulent financial reporting. A firm's management, not its board of directors, is responsible for ensuring the effectiveness of a firm's internal controls. 16 of 22 says, Edgar website is just electronic data gathering, analysis, and retrieval system. Form 10Q and SEC filings, this is irrelevant to this. So this corporate press release is the right answer. 17, least likely to be considered a role of analysis. These two are roles of analysis. So this is just the only exception. We're not going to assess the skill of the company's executives. We're seeing, should we invest in this company? Should we lend to this company? What is the credit rating that we should assign to this company's debt? What economic decisions should we make in relation to this company? So there's nothing to do with the management skill here. Question 18 is, the standard auditor's report is most likely required to provide reasonable assurance that the financial statements contain no material errors. 19, processing the data is least likely to. So it's A, because acquiring the company's financial statements, this is part of gathering the data. Which of the following is as least likely to rely as an objective information? As an objective, rely on as objective information. Government agency statistical data, pretty objective, because again, government has more credibility, and then it's statistical data, it's not someone's opinions. Proxy statements are also pretty accurate because they're being filed within the company, right? There's a primary source. Corporate press releases, least likely, right? Pretty subjective. They're written by management. They're often viewed as public relations or sales materials. They're like PR. An analyst should review information on the economy and the company's industry and compare the company to its competitors. Question 21. Which of the following statements concerning the notes to the audited financial statements of a company is least accurate? Notes to the financial statements of a company is least accurate. Financial statement notes are audited. This is accurate. They include management's assessment of the company's operating performance and financial results. Management's assessment will be always part of management commentary. Okay, management's perspective is provided in the management's discussion and analysis to supplement the financial statements. Financial statement notes provide information about matters such as the company's accounting methods, assumptions, contingencies and commitments, acquisitions and disposals. Footnotes to the financial statements are always audited. Finally, 22, in the financial statement analysis framework, using the data to address the objectives of the analysis and deciding what conclusions or recommendations the information supports is best described as analyzing the data, right? Using the data to address the objectives of the analysis, deciding what conclusions, that's analyzing the data. It's not processing. That's where you're just making adjustments, calculating ratios, reporting the conclusions. You've done of everything and you're just now telling people what you've done, right? You're not deciding anything. You're not doing any analysis. You're not making any inference. So this was it for the first reading. And now I'm gonna quickly send the second reading, which is analyzing income statements. Pretty long, pretty testable reading, very interesting also. So I'm going to send that really quickly.